Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money.
And welcome back to the Investor Coaching Show. I'm Evan Barnard, filling in for Paul Winkler, and going to cover some stuff that we don't talk about a whole lot on the show. Going to deviate from the investing piece for this segment, maybe a couple of segments, because there really is a lot more that we do with clients and that clients are looking for than strictly just investment advice. And we're going to talk a little bit about, looking for an advisor and those kind of things. But when you look at some surveys and ask people what are their major concerns during retirement, they tend to fall into four categories, maybe five. Number one is longevity risk, and certainly you hear advertisements about this all the time. Many retirees fear outliving their savings. It used to rank much lower in the past, but it's become a growing worry for individuals when they actually retire. Another big category, healthcare costs and inflation and the need for long-term care. Those are actually, kind of distinctly different things, but just, am I going to be able to take care of myself health-wise? Financial preparedness. 87% of workers lack confidence in having enough to retire comfortably. Likewise, 80% of retirees worry about maintaining financial security over their remaining years. And then savings regrets. I'm surprised this isn't 100% actually, but 76% of retirees wish they had saved more consistently. And 68% wish they had been better informed about saving and investing. And frankly, now, job insecurity and working longer. You can't go too far without hearing a story about how AI is maybe going to displace, white-collar workers or middle managers or, who knows what, paralegals, just any number of things that a lot of people are using to earn money, and they're now worried whether it ever happens or not. They're worried about losing that job, and are they going to be able to retire at all? Well, when you start to look at the data, kind of the consensus number, if there's such a thing, is about 1/3 of Americans work with a financial advisor. And so I look at that and say, okay, that means 2/3 don't work with a financial advisor. And, what are the reasons? So we're going to go through the top 10 reasons that retirees don't use a financial advisor. And I want to address those. Number one is they think they lack assets worth advising. Basically, this belief that they're too small to qualify for a financial advisor or even too small to need a financial advisor. And certainly you see these firms out there that, if you have $500,000, if you have $250,000 and so forth, there's firms that advertise that. Most of the time that's marketing as a cachet to, kind of send this message that we work with the well-heeled crowd. And that's fine. We've got plenty of clients in that category or those categories, and that's great. But we also end up working with their kids or their grandkids and, people that are just starting that really don't know a whole lot about investing. And so we've just never held to that philosophy of having a firm minimum. We think everybody deserves a great portfolio. Now, that doesn't mean everyone wants to or, is willing to pay us to do that work for them. But we certainly want to give people the opportunity to do that. So I would discourage you from thinking that you're too small to need a financial advisor because oftentimes we can have the biggest impact on the future of somebody that's 28 or 29 that's just starting out than someone that started saving at 61 and is trying to retire at 65. There's not a whole lot of extra that we can do for something like that. but you can really change your family tree getting some great guidance early on. So I would encourage you to cross that one off. Now, the next one, concern over advisory fees. It's too expensive and it reduces returns. This is a great one to have a video screen for, but in our audio format, we just can't really get there. So here's an interesting thing. For years, there was a firm out of Boston called Dalbar, and they do research on investor performance, not investment performance, but investor performance. And so, they look at thousands of transactions and statements, and they get the data of when did investors sell and buy and what did they do. And the bottom line is for 3 decades now plus, almost 4 decades, I think 38 years they've been doing this research and publishing it. The average asset allocation investor, meaning someone with a diversified portfolio, some stocks, some bonds, some cash, averages about 1.5% per year. And the market, a diversified portfolio in the same constraints, averages about 6% per year. So if we can get 1.5 for free, doing it on their own, and interestingly enough, advisory-driven things are in that number as well, which is kind of scary. Either do-it-yourselfers are really getting clobbered, or most advisors are following the same pitfalls as clients, which we see quite a bit. So if you're paying an advisor some percentage, pick a number, 0.5%, 1%, something, to achieve a 6% return, less fees, versus, well, hey, the statistics say I can get 1.5 for free on my own, that seems like a pretty straightforward decision for me. But then you have this emotional component, as I mentioned last hour, that investors all have of, well, I am the exception to the rule. We were at an investment conference, this is years ago, and this is actually when I was on the dark side. So, this is going back about 25 years. And, back then, the top mutual fund managers would go make a talk at some conference and, tell you why they did so great and were geniuses and so forth. And one of the speakers would talk about how hard it is to beat the market, and you need to diversify and rebalance and do the things that we now teach. And the consensus conversations, out in the hallway after it was done was, boy, that's so true, but my mutual fund doesn't do that. And so we always have this human thing. It's like your congressperson. No one has a high view of Congress, but they have a high view of their representative. And it just kind of goes the same way from the advisory standpoint. Is there's this real challenge to give up the belief that I can pay attention to and properly structure and rebalance and maintain an investment portfolio over a lifetime. Number 3, trust issues. This is totally valid and legitimate. It's a fear of being sold products or conflicts of interest. And a day doesn't go by that we don't talk about that, either with clients or on this show or in some of the advertisements. And frankly, that's one of the things that we get frustrated at. Paul commented on the interview with Chris Friday morning about this is, this fiduciary standard, which we adhere to by statute because we're a registered investment advisor, is really not strong enough to accomplish what it is for protecting investors and this, acting in someone's best interest. It's just not policed very much. And so people hear maybe this fiduciary language, and then they go meet with someone and they say, well, hey, we think you should buy this, and you should buy this real estate trust, or you should buy this annuity or something. And you're thinking, well, I was coming here to get advice and, kind of be on the same side of the table, and now you're selling me something. And frankly, on the trust issue side, even if you have a great advisor or you're interviewing an advisor with tremendous integrity, all that kind of stuff, we still have enough of a context of people like Bernie Madoff and Alan Stanford down in Texas, and whoever the next Ponzi scheme is that hasn't been caught yet. There's just this constant underlying thing of, can I trust the individual? Can I trust the firm, and so forth? And that keeps a lot of people from hiring an advisor, and that's unfortunate. Number 4, a belief they don't need one. We kind of talked about that before. Somebody is comfortable managing the investments themselves, and that's fine. But let's think about what that entails, is managing the investments themselves. We talked about kind of how the market worked, what affects stock prices and so forth going forward. What are some of the metrics people use to buy and sell stocks, which we disagree with, but is a very common trait for people self-managing their portfolio. Well, let's look at some of the largest bankruptcies in world history. None of these were Ponzi schemes per se. These are all publicly traded corporations that had tens of thousands, if not hundreds of thousands, of investors all thinking this was a good stock to buy. The largest bankruptcy in U.S. history in the market was Lehman Brothers back in 2005. They lost $691 billion. Second largest, Washington Mutual, $327 billion. Silicon Valley Bank, if you remember when some of these interest rates shifted and all of a sudden they couldn't handle the bond fluctuation, went under, $209 billion. Signature Bank, $110 billion. WorldCom, which previously I think was MCI, $104 billion. Local number is still the 6th largest corporate bankruptcy. General Motors, $82.29 billion, and so forth. Enron, Conseco, some of these names, even PG&E, Pacific Gas and Electric, bankrupt $71 billion. So, I talk about donuts. I'm going to shift gears here, but this makes sense. When we talk about managing a portfolio for a lifetime, compare that to me trying to lose some weight. If I'm on a weight loss program, I'm eating right, things are going great, I'm getting into the gym the days that I want to get there, and then I happen to go to work about 7 o'clock, go by the Krispy Kreme and the red light's on, and I pull in and get a couple of donuts, and I eat those on the way to the office. And they don't even make it to the office. I just get the napkins and they're gone by the time I get there. That's not going to totally stop my heart. That's not going to cause any dramatic effect. It could cause me to break my routine a little bit. But basically, that's not going to totally throw me off. Investing just doesn't work that way. It only takes one mistake over 40 years of investing, and all of a sudden, your retirement future is radically altered. We were at a workshop one time, and a gentleman had a very large position in Boeing. And this was about 6 years ago, I think, that this took place. And he had worked there. He might have even still been there, but I think he had retired. But he had an enormous position in Boeing, and he could do it himself. He didn't need an advisor. Well, about 6 weeks after that workshop, Boeing dropped about 50 or 60% and proceeded to go down about a total of roughly 75% over the next few years. It's eked its way back up a little bit. But picture, and the numbers aren't quite accurate, they're close, but picture the fact that he had $10 million of Boeing stock. And a year and a half later, he had $3 million of Boeing stock. That's a very different future. And even if you reallocate at that point, the damage is done. It's not like sneaking a donut in and, you just cheat on the diet for one day. Next, Number 5, I don't know how to find a good advisor or a credentialed fiduciary. Well, there's lots of places you can go. The CFP board, I think it's mycfp.net. I think they have a directory of people that are certified financial planner designees. The American College, I honestly don't know if they maintain a database of people that have the chartered financial consultant. Some people have chartered financial advisor. Some CPAs engage in planning, and you will sometimes see them. I want to say it's PFS. I might get that wrong. But they have done some additional investment education in addition to being accounting professionals. But that's one of the things that we are very big on is everyone running our offices either has a CFP or Chartered Financial Consultant, CHFC. Why? Because it's important to have something that shows, number one, that you're committed to education, 2, that you have this reasonable belief to be competent in that arena, and it just helps provide that reassurance. We kind of went back to trust issues again of, does this person know what they're doing? Doesn't always mean that they do. Over the years in any profession, just like the professions you're in, there's people that have risen up to the top and you just scratch your head and wonder how they got there. And then there's people that seem to be getting passed over, and they're the ones that the business relies on to keep the lights on. But basically, you do want to have someone that has a credential of some variety related to planning for sure, if you're going to, have some trust and accept their advice for what it is. If they give you advice and you don't think they know anything, the advice is next to worthless. We will hit the next 5 when we come back from this break. You're listening to the Investor Coaching Show. I'm Evan Barnard on WTN 99.7.
Hey, just a note to you podcast folks, we just came out with a retirement income guide, and I'm super excited about this. There are all kinds of myths about taking income in retirement. People worry about running out of money, and rightfully so, because a lot of these myths can actually cause that. Now, the myths that you typically hear about, number 1, dividends, living off dividends in retirement. Real estate, life insurance as a retirement investment, and annuities, and interest-bearing accounts, and target date funds. There are all kinds of things out there. What I want to do is put something together that walks through why those things are problematic, number 1. Number 2, the other thing that I wanted to do is walk through the evidence-based research on taking income in retirement. And we got a ton of data going all the way back to 1900. What's the logic behind it? And it's intensely logical. So we put that together, and all you have to do to download that, making it super simple, just go to paulwinkler.com/relax, and you can actually get into that very easily right there. So I would urge you to do that. Check it out, because I think you're going to really like it. paulwinkler.com/relax.
I've got to jump in, but I could just sit and listen to that for a little bit. Welcome back to the Investor Coaching Show. I'm Evan Barnard, filling in for Paul Winkler this afternoon. And we're going through the top 10 reasons that people don't hire a financial advisor. As I said earlier, about 2/3 of the country don't use an advisor. Number 6, fear of losing control over their investments. And I would bet if we were to prioritize these, that would be really close to the top of the list. So let's spend a little bit of time on that, because number 1, it assumes the investor has control over their investments in the first place, even if they don't hire a financial advisor, because that presumes if I'm losing control, that means I was already in control. The data shows that investors are hardwired to fail. That doesn't mean they will fail, and that doesn't mean that they're bad people. It's just the way that our brain is wired causes us to historically make bad decisions around investing for the wrong reasons at the wrong times. So even if you're self-managing and you say, hey, I don't want to lose control, so I'm going to do this my own because I don't trust the advisor or whatever, you have all kinds of investor biases going on in your own brain that cause you to build the portfolio a certain way. You may look at hindsight bias, that's really the chasing performance bias as much as anything. This investment did really well the last 2, 3, 5 years, 10 years. Man, you hear that all the time. Look for a fund with a good 10-year track record and put it there. Just because a company did well in the past, we were talking about Boeing last segment. Just because it was doing well doesn't mean the stock can't just crater because of one or two big errors. False patterning bias. You may see that, hey, every time, Trump does a tariff, the market does X, and then it responds this way. I'm going to try to get ahead of that, and I'm going to place this particular transaction because I see this pattern. And then he doesn't do it that way, and the pattern falls apart, and you've cost yourself money. Sometimes it's prestige bias. You may own a particular stock or use a particular advisor because everyone in the club uses that advisor, and I want to be known as the person that has that much clout, that I can use that particular person. Confirmation bias. In preparing for the show throughout the week, Paul doing his research, me looking at things, I could support almost any forecast about what the market is doing with any number of articles from Bloomberg, from the Wall Street Journal, from Investment News Daily. If you read enough information, you can find several articles that will support whatever prediction you think is going to happen. And you use that as confirmation bias that, hey, my prediction is right, and I'm going to dump a bunch of money in this stock or this sector or this mutual fund. And so we really don't have control over our investing. And the biggest thing that I would say, though, at least with us and any, I should say, reputable firm, that's a challenging word, probably regulator-wise, but you always have an investment policy statement, or you should have an investment policy statement that says, in writing with signatures, hey, this is how the portfolio is supposed to be managed. These are the types of investments you're going to use. This is how we're going to rebalance the portfolio. This is the strategy that we are using. All of that should be in writing, and that gives you, as the investor, ultimate control over your portfolio and those decisions. You're just not executing the strategy on a daily basis, but you're the one that says, this is what I want you to do for me. And then you're not guided by your emotions, but you do have control because you've got a written contract that says, I want you to follow these rules in managing my portfolio. So in my view, you really do have more control hiring an advisor as long as you have a good, solid investment policy statement. And some of these are in very similar category. Might blow through these. Preferred do-it-yourself investing tools or robo-advisors. Same thing. That may be exciting, but at the end of the day, if you have a robo-advisor, you build a portfolio and you give it some constraints, and the computer just trades your account. As long as you can log in and click a mouse and change your strategy or get out of a particular position, you are no better off than if you were just doing all of the transactions yourself. Limited awareness of advisor services or benefits. Some people just don't know what all does a financial advisor do. We've talked about that some on the show as well. You can get all kinds of information on our website, paulwinkler.com, going through those things. But there's a whole range of issues that are totally separate from just the investing piece to help minimize taxes, make sure you've got all your risk management stuff, your insurance-y things in place, make sure you're taking advantage of all the company benefits you have, all those kind of things that sometimes fall by the wayside, and making sure that your estate is properly structured to go to the next generation. We'll talk about that for the rest of the hour when we come back. But, some of it is just a mistrust of institutions or advisors based on negative stories. so-and-so stole money or so-and-so was crazy or something like that. And that goes to it indicts the whole industry just because you have an anecdotal story of a family member that maybe got taken advantage of or something like that. Or you maybe worked with an advisor that put you in some stock that they said was going to be great and you lost money. And so that governs kind of how you view the industry. So, there's a lot of reasons people don't do it. I would encourage you to just investigate it for yourself and see, what it is that you're looking for in an advisor and take advantage of that. It's always good to have a second set of eyes on things and have a sounding board before you make a decision rather than going to talk to somebody after you've made a decision. And sometimes those bells can't be unrung. We'll be back after these breaks. You're listening to the Investor Coaching Show on Super Talk 99.7 WTN. I'm Evan Barnard.
Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.